Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Last week, Donald Trump began imposing his Liberation Day tariffs on friend and foes alike, while Australia is yet to receive a so-called tariff letter. Presumably one is on the way ahead of the implementation date of 1 August. What should investors make of these new tariffs? How should they respond? To help find answers to these questions, I welcome to Fear and Greed Damien Hennessy, Head of Asset Allocation at Zenith Investment Partners. Damien, welcome to Fear and Greed.
Thanks, Sean. Thanks very much for having me.
Before we get to the investing part, broadly, what do tariffs and what's going on in the global economy, or what does it mean for the global economy? What's the macro background for investors to consider?
Yeah, I think as you highlighted, tariffs has been a dominant feature since the beginning of April. So when you think about, the market tends to think about what the average tariff rate is likely to be in the US. That's the way they sort of determine what the impact might be. And suppose if you go back to early April, when the tariffs were initially announced by President Trump, the average tariff rate looked like it was going to be something like 28%. Remember, it's been 2.5% for the past 30 years. So this is an enormous increase in the average tariff rate. Of course, that's changed over the period. That went as low as, came by May, when the tariffs on China were cut back from, remember, 145 down to 20 to 30%. It meant the average tariff rate in the US was now closer to 15%. And markets like that. But of course, since then and over the last few days, we've had various announcements of higher tariffs, across Japan, Korea, Vietnam and Brazil. And so it leaves the average tariff rate a bit higher. So cut to the chase, what it means most likely is a lower growth outlook and a higher inflation outlook, the so-called stagflationary impact, if you like.
Okay. So who pays the tariffs, right? And how should investors respond? So let's start with who pays it, because I'm sure the investment part kind of comes back to who pays them.
Yes. Yeah, look, maybe I'll use an example. So think of a washing machine. I don't know why I think of washing machine, but let's talk about that. So it comes,
fairly appropriate, I think. Yeah.
Very appropriate. So it comes into the US, say at $100, let's say from China, and that's paid for by the importer. So they're paid $100. They then on-sell it. They want to take their profit margin. They sell it on to the wholesaler at, say, $150. The wholesaler then sells it on to the retailer. Let's in this example use $200. So everyone's making their roughly a 50% margin, and the retailer then sells it to the end consumer for $300. So that's where things were pre-April 2. So post April 2, the 20% tariff on that same washing machine, the importer pays it initially. But of course, if they want to maintain their margin, they're not going to sell it for 150, are they? They're going to sell it for 180. 180 will allow them to maintain their margin. And then, of course, the wholesaler's not going to want to have their profit margin hit, so they're going to up their price in selling it to the retailer. And likewise, the retailer, if they want to maintain their profit margin as it was previously at, say, 50%, they're going to sell it on to the consumer at 480. So that fridge has all of a sudden gone up quite considerably to the consumer. So there's your sort of first level direct impact from a tariff. Consumer pays. However, in a world where typically, in this example, most goods are getting some sort of tariff. And in many instances, there isn't a domestic alternative to that product, to that good. And so what it means then is if a lot of goods are attracting tariffs, then the real spending power of the US consumer declines. They've got less money to go around much more expensive goods, so they cut back their spending. Or the way this could flow through to the corporate sector is their profit margins then have to take a hit. So the consumer pays ultimately, and probably to a lesser extent, the corporate sector has to pay through lower profit margins. And this is the way tariffs work their way through the economy. It's not, as the Trump administration has said, it's not as if the foreign countries pay the tariff.
Okay, so whichever way you look at it, whether the consumer is paying more or the company is taking a bite out of their profit, it's poor for economic growth. As an investor, what do you do? And just broadly, firstly, how do you think about it?
So you might be familiar with the term the taco trade. So that's become quite a bit of a joke around markets, but it's been real. So we've seen on a number of occasions when these big tariffs are announced, they're subsequently withdrawn when the markets start to reflect all the uncertainty and the impact on growth and inflation. So when you think about it from the impact on growth and inflation, I think you probably would say that it's a negative, as I mentioned before, it's a negative impact on growth. It tends to lift inflation at the margin and can have an impact on corporate profit. So from an investor's point of view, you've got to weigh up all those factors. But in addition to that, you've got to weigh up whether those tariffs are going to be sustained or not. And this is where it's highly uncertain for investors.
Stay with me, Damien. We'll be back in a minute. I'm speaking to Damien Hennessy, Head of Asset Allocation at Zenith Investment Partners. Before the break, I think the last word you used was uncertain, and uncertainty kills financial markets. People don't like that. So let's talk about specifically how to invest. And I want to come to asset allocation because many returns, actually it's asset allocation as much as it is the stocks you pick or the bonds you pick. So start with equities. If you want a balanced portfolio, if you want a good portfolio, balance has got a specific meaning in investing, and I don't actually want that. Like if you have a decent portfolio in your mind, Damien, what should you be doing about equities, local and international?
So when it comes again to the tariff question and the impact of tariffs on markets, I suppose on the one hand, equity, so earnings can stay up relatively high as long as I said before, profit margins don't take a big hit. So it depends on how the consumer reacts. And if the consumer pull their spending habits in, then that will ultimately flow through to equity markets. But it's interesting if you look at the performance of equities over the last, say, couple of months, and particularly, I'll start with the US. You've seen the return of the Magnificent Six or Seven. They've started to produce really strong returns once again. And the reason for that is they're not that much impacted by tariffs. That's part of the reason. And their earnings growth continues on despite the uncertainty. The other, I guess, larger part of the US market, that's probably more sensitive to the tariff increases. So we would sort of feel that, US equities can keep doing okay, but you'd probably be very careful about the sectors that you're involved in. Don't be investing in those that are impacted by tariffs. And those sectors tend to be financial. Some of the tech sector can do reasonably well. What we would also advocate is broadening out your exposures out of just US equities alone. So Europe seems to be really well positioned. Yes, they'll be hit by tariffs, but on the other side of the coin, they are busily spending on infrastructure and defence, or at least will be over the years ahead. So that's a positive. And of course, they got lower interest rates. As Trump keeps pointing out, they've cut rates about 8 times. So Europe is reasonably well positioned, and closer to home domestically. Well, we're not hit that much by the tariff policy, and in fact, I would think that the impact of tariffs would tend to be more disinflationary here in Australia, and the reason for that is China and other countries, if they can't be selling as much to the US, will probably divert some of that back to those exports back to Australia at potentially lower prices. So that's sort of good for the domestic economy because it takes inflation lower, allows the RBA to step in and possibly cut rates a couple more times this year. So overall equities look okay. I think it's now time where you can really make some good decisions around what sectors you're in, less impacted by tariffs, and broaden out your country allocations.
Bonds,
tricky. Are not going to always provide the diversification that you have become used to. And the reason for that is that stickiness in inflation as a result of tariffs. So, yes, you've got to have some, I think, in the portfolio for that recessionary risk that it always lurks out there, but they're not going to provide you diversification if we get a bit of an uplift in inflation.
Okay, what about real assets? So property, infrastructure, those sorts of assets, listed and unlisted.
Yeah, I think they're well positioned. So if you were to say to me, growth's going to be a little bit lower and inflation's going to be a bit stickier or a bit higher, I would immediately go, well, yeah, real assets look well positioned for that. They're a function of real yields, and real yields are at levels that a fair value, if you like. So yes, we would tend to have a preference for real assets.
Okay, and then alternatives outside real assets?
Yeah, it's such a wide range of different exposures that you can have
Yeah.
in there. I suppose some of them have a role, those that provide sort of tail risk hedging characteristics, in the event that we're all wrong and the markets take a massive hit from tariffs. So, yeah, be very specific, and it's very, very strategy and fund manager driven, that part of the market.
Okay. The other interesting, we don't talk much about currency. I'm sure you talk about currencies all the time, but we talk about asset classes, but currency can make such a big difference to your ultimate return and how you treat currencies, whether you hedge or not. What's your take on the Aussie dollar for, Australian investors?
I think right now it's more about US dollar, not so
Yep.
much Aussie dollar. So it's US dollar against everything else. US dollar has been very expensive and strong for a number of years. I think the current administration, the US, probably prefers a weaker US dollar. And most of the policy announcements are probably leading that way. So tariff policy, to the extent it reduces the deficit, probably means a lower US dollar, less requirement for money to flow into the US. The concerns over future Fed independence, that tends to undermine the case for US dollar strength. So I think it's more about that. So from a portfolio perspective, I would suggest, and what we have been doing is increasing our hedge ratio. So being a little bit more in Aussie dollars and a little bit less in foreign currency. But again, it's more of you'd prefer to hedge the US dollar positions rather than the euro and the yen, which those currencies also look quite cheap.
We are totally out of time, Damien. In fact, we're about 2 minutes over time. However, bottom line here, as an investor in Australia, what is it?
Well, stick to your long-term plan. There will be some volatility, I think, over the months ahead because markets are finely priced, but I would suggest to investors stay reasonably well diversified. Only put positions on where you have a sort of a strong conviction around the medium-term economic outlook.
Damien, thank you for talking to Fear and Greed.
Thank you very much.
This is the Fear and Greed business interview. Remember, we are not an investment podcast and this is not investment advice. If you want to invest, we always recommend visiting a financial advisor. Join us every morning for the full episode of Fear and Greed, business news you can use. I'm Sean Aylmer. Enjoy your day.